The Gartland Group presents Taxes, the IRS, and You with your host, Bernie Gartland. Taxes, the IRS, and You is a different kind of show that'll help you solve your tax problems. As former Deputy Attorney General of the state of Delaware and with over 25 years of experience as sole practitioner in both Delaware and California, the name Bernie Gartland has become synonymous with taxes. And now your host, Bernie Gartland.
Hey everybody, this is Bernie Gartland. The name of the program is Taxes, the IRS, and You, and we are produced and sponsored by the Gartland Group. We come to you every Wednesday. Normally I have guests in the studio. I have sitting down at our conference table, and we have a general discussion on many concepts such as golf problems with 1099s for golf professionals, or whether or not you should incorporate a business and what the ramifications of that are, and trusts and what you can and cannot do with a trust. And we talk about a $1.6 million problem that the attorneys didn't know how to handle a certain concept with transferring property into a trust. We talked about the three-part problem-solving process. Now, you know, at Gartland Group, we have three entities. One is the Gartland Law, the other is Griffin Bookkeeping, and the other entity is American Tax Centers. We talked about this a lot. We talk about the one-stop shop so that you guys and gals out there with audits, with tax problems that you need solved, bank levies, liens, offering compromises, tax bankruptcy, you know to call us to get a free consultation. The reason I've decided today not to have any guests in is because there is three areas, possibly four, but three areas for sure that I'm finding out more and more and more that the general professional public out there, attorneys, CPAs, and enrolled agents, have not figured it out. And I'm getting more and more people in here that have had problems. It should have been resolved. They have not been resolved because the certain professionals are not up to date on what the rules and regulations are. And for instance, I've just had one client came in last week because an attorney out of Riverside didn't understand the bankruptcy code, and the client now owes $124,000. We have many items, people coming in that their bookkeepers are not paying their 941s, and they are a corporation, and therefore the IRS is coming after them personally. We have discussed all these issues with our clients, and we have established something called a three-part problem-solving process. The first part of the problem-solving process is to send for and analyze all the information that the IRS has on you, while at the same time getting information from you so that we can do the second part of the problem-solving process, and that is the actual tax preparation. The third part of the problem-solving process is giving you your options. And I'm going to tell you what your options are, but I want to go into one specific option because this is where the misunderstanding has occurred. When somebody ends up owing a lot of money to the IRS, or even a fair amount of money to the IRS, there are several options. One is don't do anything, and then they'll do it to you. And number two, beg, borrow, steal, I don't care where you get the money from, pay the tax debt. Number three, if the first two don't work, then you set up an installment agreement with the Internal Revenue Service. And that's based on submitting certain financials to them. And we work out an agreement with the Internal Revenue Service, releases levies. Liens are not released when you do an installment agreement. The next option is disappear for 10 years and you don't owe it under Section 6502. The next option is something called an offer and compromise. That's where we say, hey, IRS, I owe you this amount of money. How about taking this amount of money? Let's call it even. We have a very high percentage rate on offers and compromise because we don't do an offer compromise unless we think it's going to work. As you know, there's four major companies that have been closed down because they were giving fraudulent information out concerning offer and compromise, and they were the national companies, and a lot of them were being prosecuted. The next option is file a Chapter 7 bankruptcy. Wait a minute, are taxes dischargeable in bankruptcy? Yes, they are. Well, let's go into the next option and then come back to this one. You have something also called a Chapter 13 reorganization, where you can stop all taxing authorities from coming after you and set up a payment schedule for 5 years through the bankruptcy court. And the last option is something called a currently non-collectible category. That is, under Section 6343 of the Internal Revenue Code. And remember, this is not policy. This is, in fact, a law that says if it would cause an undue hardship for you to pay your taxes once they've been assessed, then the Internal Revenue Service must stop levying either your bank account or your wages or anything of that nature. They have to leave you alone if you qualify under the what we call currently non-collectible. In fact, there's a code number that is put into your computer transcript that shows it's actually a 530. But what we want to do is we want to talk about bankruptcy. This seems to be an area of new development, and that is why I wanted to take the time to talk to you about in the first and second segment. There's a Ninth Circuit case that just came down. The Ninth Circuit case is called ILCO versus California State Board of Equalization, and it's a recent case. It's the Ninth Circuit. What means the Ninth Circuit means now this is what the law is now, unless appealed to the United States Supreme Court, and this is never going to be appealed to the United States Supreme Court. Apparently, Mr. Ilko had a company that he closed down in the early 2000s, and he just walked away and closed it down. Several years later, he filed a Chapter 7 bankruptcy. Now, here is something that I have known for a long time. Sales taxes in the state of California are dischargeable in a Chapter 7 bankruptcy. Let's go through that again, because there's a lot of practitioners out there in the bankruptcy and tax field that never heard of this. Sales taxes are dischargeable in a Chapter 7 bankruptcy. Dischargeable means they're eliminated. You do not have to pay them anymore. They normally have to meet 3 basic requirements. 1, that the tax year in question is more than 3 years old, plus about a half a year for some other measure. Number 2, that the form is filed 2 years prior to the bankruptcy. So the year has to be more than 3 years old, plus another 60 days to 6 months. The proper form has to be filed 2 years prior to the bankruptcy, and the taxpayer has to be assessed 240 days prior to the bankruptcy. So now what we have? Well, Mr. Ilko closed down his company in around 2000, 2001, and files a Chapter 7 bankruptcy several years later, and he put down the sales taxes for dischargeability because, in his mind, they were more than those qualifications that I pointed out to you. The problem is, there is a problem. And after our break here, and we're going to have our commercials, and I'm going to come back to you and I'm going to tell you what the problem is. Remember, sales taxes are dischargeable. ILCO had a problem. Hi folks, I'm Bernie Gartland, and I'm so proud to introduce you to the Gartland Group. Do you have a need to have your current or prior year tax returns prepared? Is the IRS knocking at your door and you need legal representation? Do you need professional bookkeeping services? The Gartland Group can help. Let us put control back in your life and have that control give you a future.
Call today for a free consultation.
Hi, this is Bernie Gartland. Welcome back. The name of the program is Taxes, the IRS, and You. And today I've decided that I wanted to talk to you all out there one-on-one because I didn't want to get distracted by having guests and different attorneys and other real estate people come in and talk to you about issues that pertain to them in that area. What I want to talk to you about is sales taxes being dischargeable in bankruptcy. And I want to make sure that every single business person out there that has to have a license with the State Board of Equalization and collect sales taxes and remit to the IRS, to the State Board of Equalization, I want you to make sure that you listen to this segment because it affects you. Excuse me. We were talking about Ilko, a case in the Ninth Circuit, where several years after he closed his business down, he filed a Chapter 7 bankruptcy, and apparently he and his attorney thought that the taxes for the State Board of Equalization, the sales taxes, would be eliminated. Well, here's what happens. What happened is the California State Board of Equalization filed an objection, and the Ninth Circuit upheld the California concept. And this is the concept. Under 6829 of the California Code, an individual inside a corporation can be assessed personally sales taxes that have not been remitted to the State Board of Equalization. Now, in Ilko's case, it was over $85,000. Well, was the tax year more than 3.5 years old? Yes. Was any paperwork submitted 2 years prior to the bankruptcy? No. And was Mr. Ilko assessed no. Well, what happened? California Code specifically says if you do not, at the close of your corporation, notify the State Board of Equalization as to your closure, they don't assess you for many, many, many years. And that's what's happened in Mr. Ilko's case. He did not indicate any closure. Now, it isn't that simple. Well, how about if I just write a letter to the State Board of Equalization, and say, look, I'm closing down my business. Have a nice day. That's not what the code says, and that's not what the Ninth Circuit said. What the Ninth Circuit said was this. The individual who could be held responsible for the taxes under the Personal Assessment Code 6829 must file the closing statement on the proper form for the sales tax at closure. Now, wait a minute, this sounds ridiculous. Shouldn't the corporation just file the final paperwork and say we're closing? Well, one would think, and I think a lot of us thought that that was all that was necessary. The Ninth Circuit has determined that any person who could be held responsible personally for the sales tax, that person has to file the final form, and his signature has to be on there, not the corporation. If that is not done, then the State Board of Legalization has no duty to assess you. Now, normally, when you file the proper paperwork, the State Board of Equalization only has approximately 3 years to assess you. But that's 3 years after you file the proper paperwork. And again, I'm going round and round and round because the proper paperwork is just not simply a letter to the State Board of Equalization saying I'm closing down. It is not the corporate president, vice president, secretary, treasurer of issuing the final sales tax form to the State Board of Equalization. It is the actual signing of that closing statement by the member who could be held responsible. And if that isn't done, then the statute doesn't even start. In other words, you can wait 3 years, and that's what Mr. Ilko did. He waited 3 years, and in fact, he waited over 3 years, and went into the bankruptcy and said, well, they didn't assess me, so they can't come after me. He was assessed after the bankruptcy because then the State Board of Equalization has up to 8 years to assess you if you have not put in the final form. Can you imagine the ramifications of this? That you close your corporation down, you haven't been assessed, 3 years go by, and you're saying there saying, hey, I'm home free because I haven't been assessed. So therefore, they can't come after me because I closed the business down. They haven't assessed me for 3.5 years. I'm home free. And you go into bankruptcy for other matters. You list that sales tax down. And all of a sudden you find out you didn't do it properly. Now remember, State Board of Equalization sales taxes are measured on gross receipts. They are not a trust fund portion. Therefore, when something is measured on gross receipts, in other words, you make a sale, you collect the sales tax, it's measured on the gross receipts. You're not holding it in trust for anybody. That can be discharged in bankruptcy. And as we just found out, it can be discharged only if the tax period is more than 3 years old plus extensions, only if they've been assessed 240 days prior to the bankruptcy, and only if the proper paperwork was signed and delivered 2 years prior to the bankruptcy. I have to go over this again. You people who have the mom and pop organizations out there, the mom and pop corporations out there, if you are having hard times, as we see all the time here, don't complicate your life and making it 4, 5, 6, 7, 8 years from now still a problem for you when you started getting back on your feet. Don't have that happen to you right now when you're closing your business down. And I know it goes against your grain because things are happening and you don't feel good about yourself, or the economy is going bad, or you may have some marital problems because of the closure of your business. Make sure you understand the proper procedure for making sure that you get assessed the tax that eventually can be discharged in a bankruptcy. You, as a principal in the corporation, have to file the final, prepare and file the final paperwork so that you then start the 3-year statute on being assessed by the State Board of Equalization. If you don't, then you're going to find out 5, 6, 7, 8 years from now, you are going to be in trouble, and they're going to come after you, and they cannot be discharged then because why? If you file a bankruptcy in the meantime, you can't file a bankruptcy for another 8 years under the 2005 Bankruptcy Code. So when we get back, we're going to now talk about IRS and EDD and how they can be affected in bankruptcy or not. So when we come back, we're going to talk about the next segment.
Hi, I'm Al Geiberger. As Mr. 59, I can teach you how to get out of trouble on the golf course. But when it comes to trouble with the IRS, I can't teach you a thing. That's why I went to someone I knew I could trust, Bernie Gartland and the Gartland Group. After seeing how they solved my IRS problems and handled my tax preparations, here's my tip from Mr. 59. Don't take your tax returns to anyone else.
Hi, everybody. Bernie Gartland, and welcome back. The name of the program is Taxes, the IRS, and You, sponsored and produced by the Gartland Group, which consists of American Tax Centers, Griffin Bookkeeping, and Gartland Law. We were talking in the first segments about the new Ninth Circuit decision that really affects everybody who has businesses that has to remit sales taxes to the State Board of Equalization. If you need to know more about that area, you can always set up a conference with me. We don't charge for consultations, but this case is so important and it's so new that it's going to affect your future. Now, let's talk about some other areas that are totally misunderstood by most bankruptcy attorneys, and in some cases, tax attorneys who do not understand bankruptcy, and bankruptcy attorneys who do not understand taxes. All of you guys and gals in business, you know that you have to file a quarterly report called a 941. Now, I'm not going to get into particulars on how you make your deposits, on whether weekly or biweekly or even once a year. I'm not going to get into that aspect, even although that is something to be thought about. You file your 941s. Now, the example that I give is this. You own a corporation and you have one employee, and that employee you pay $200 a week. So now Friday comes along. Now, do you give that employee $200? No, you don't. What you do is you give them the net payroll, which is $160. You then take the $40 and you hold it in trust for the taxpayer as well as the government. You also do something else. You also have a responsibility of doing what is called a matching fund portion, a percentage of the Social Security. So you have two things that you have to remit to the Internal Revenue Service, to the government. Number one, the withholding, that $40 from the $200, and a percentage for the matching fund portion, which is the Social Security. When your corporation fails to send that forward, the corporation now gets hit with non-payment penalties, failure to file penalties, all kinds of penalties, all kinds of interest on these trust fund portion, that $40, as well as the matching fund portion, which is a small percentage. Then the IRS gets in touch with you and says, look, your corporation now is behind, and I've had it as high as $500,000. $300,000. Right now, just recently, a client came in, they owe $189,000 for the trust fund portion and the matching fund portion. Interest and penalties accruing all over the place. When the corporation has trouble making payments on these arrearages, there is a section of the Internal Revenue Code, it's section 6672. Write that down, section 6672. It's known as the 6672 penalty. It's known as 100% penalty. It's known as a trust fund penalty. What happens is, under that code, any responsible person, I didn't say corporate officer or shareholder, any responsible person, could be a board of directors member, could be a shareholder, could be the president, and it could be a general manager, or it could be a bookkeeper for the corporation. Any person that was helping run the business that had knowledge that the 941s were not being paid. In other words, our example is the 941s were not being paid because you had to use it elsewhere for electric, for promotion, for marketing, for rent, for whatever. They weren't being paid. Not only does your corporation owe the money, but under Section 6672, the Internal Revenue Service can assess you and any other responsible person the amount of the trust fund. That could be $40,000, that could be $100,000, that could be $200,000. They assess you personally and can go after your bank account, file a lien against your house, take the dog, cat, the canary, everything. How do you prevent that? Well, you prevent that by doing a business analysis and downsizing a little bit. Now, what happens if you get to a point where you say, wait a minute, I am so upside down in this business that I owe $189,000, and probably $70,000 of that is the trust fund portion. Every bit of money that I'm bringing into the corporation, if I pay that $189,000, it's like wasted money because the interest and penalties are continuing. Then my suggestion is, if you were in that predicament, close the corporation down and assume the responsibility of the trust fund portion. Now, this is a little bit different than what I told you about the sales tax under the Ninth Circuit decision. There doesn't have to be any final form for the IRS to have to assess you the 6672 penalty. Whatever the amount is owed, and you filed those 941s, even if they're late, and you filed them, and they're filed by the corporation, the Internal Revenue Service has a little over 3 years to assess you. It's a little more technical than that, but I'll just say 3 years. If the IRS does not assess you within that 3-year period, then they cannot assess you afterwards. Now, one of the reasons they sometimes look at it and they don't want to assess is that if the person is so broke, so insolvent, they may just bypass it. But if it's for a significant amount of money, they will assess you. Okay. Now, normally what happens is when a person finds themselves in that position that they end up owing all these 941 taxes that could be assessed against them personally for the trust fund portion, they owe Visa, MasterCard, JCPenney's. They got judgments against them. They got leases with the business that they have 5 years left on. So they decide to go into a Chapter 7 bankruptcy. Specifically, under Section 507 and 523 of the Bankruptcy Code, the trust fund penalty assessed under Section 6672 are not dischargeable. They're not dischargeable. So we have to create a strategy so that when you go through the Chapter 7 bankruptcy and you get rid of all these judgments, all these problems, all these leases, all these people hounding you, you're still going to have the trust fund portion that you have to deal with afterwards. Now, you can deal with it by doing an offer and compromise. You can deal with it by doing a Chapter 13 reorganization. I had an example where we closed the business down, and the person had a $30,000 trust fund portion that he would be responsible for. We put him into a Chapter 13 reorganization. It's 60 months. 60 months into 30,000 is $500 a month. So for $500 a month, we got that portion taken care of after we did the Chapter 7. And a lot of practitioners will tell you you can't do a Chapter 13 after a Chapter 7. That is incorrect. You can do a Chapter 13 after a Chapter 7 if it is a 100% payback basis. But think of it. Section 362 of the Bankruptcy Code stops the IRS and any other taxing authorities from coming after you. EDD. Normally, if you have a business and you have a 941 problem, which results in a personal assessment against you, you're going to have an EDD problem. Are EDD taxes assessed against you personally, even though they were a corporation? Yes. Under California law, they look at what the corporation is. They don't have the same requirements as the ILCO case that I talked to you about. They assess you. You now owe the IRS and the EDD, the trust fund portion of your corporation. You need to think about how you're going to handle this situation. And one of the things that we do is we sit down and we strategize with you. It makes a difference of whether you're in a new business. It makes a difference of whether or not you want to go into a 13. It makes a difference of whether or not you want to do an offer and compromise. Yes, EDD and the IRS has offer and compromise programs for the trust fund portions. What you must realize is that before you file any bankruptcy, see us. This is Bernie Gartland saying thank you. We'll see you next week.